thank you. Welcome to Asset-Based Finance, the engine of private credit. I apologize, I know we're probably the last thing standing between you and a cocktail or an evening party, but we'll hopefully make this entertaining for you. With that, I'm going to ask the panelists to introduce themselves. Satish?
Yeah, thank you for having me here. I am Satish Mansukhani. I'm the investment strategist at Rithm Capital. Rithm Capital, for those of you who don't know, came out of Fortress in 2022. We started in 2013 at Fortress. We are fully owned the 5th largest mortgage lender, 2nd largest lender to home builders, one of the largest mortgage servicers in the country, and also fully owned Sculptor, formerly known as Oxif. Recently bought Crestline out of Horvath, and through our acquisition of Paramount, are the 4th largest landlord in New York City.
Hi, everyone. Missy Dolski. I'm a partner and the global head of our asset-based finance strategy at Värde Partners. We are an alternative credit manager. We've been around for over 30 years, investing in asset-based finance, real estate, corporate traded credit, with a focus on Asia credit as well.
Hi, everyone. My name is Tina Suhr. I'm head of alternative credit for New York City pension funds. We are a 300 billion pension funds. Probably 3rd largest in the country. So alternative credit is everything below investment grade. We have the flexibility to invest in public, private, structured credit, asset-backed. And it's about 20 billion portfolio, and we are actively deploying.
Hi there, Paul Horvath. I'm the founder and CEO of Orchard Global. We're not 300 billion, we're 10 billion, but 10 billion fixed income alternative asset manager. Best known for our leadership in bank SRT, CRT, regulatory capital. We do with banks. We have a co-lending on hard asset lending with banks. We have a derivatives, investment grade derivatives long short program with banks. And we are a CLO fund of funds.
Great. And I'm Michael Peterson. I run Citco's global lending business across funds and allocators. With that, I wanted to talk about the evolution of the product itself. Private credit is probably misused or overused, depending on your point of view. But Paul, you have a very interesting background in terms of kind of where you started and obviously running an asset manager today. A little bit of the evolution, if you could, just on kind of the product asset class, and we'll go from there.
Sure, well, I'm glad you asked the question because what we are, who we are, and how we differentiate derives directly from our pretty unique background. So I actually started my career down the street from where Tina works. I was at the Federal Reserve in New York during a very interesting time. It was during the savings and loan crisis. Now I was pretty junior, but I was very junior. I had a front row seat to watching how the regulator, put Humpty Dumpty back together in that financial crisis. And what I learned was that he or she or they in the private sector who brings capital to work with the banks, work with the central bank to help recapitalize the banking system during and after times of financial crisis will get paid supernormal returns. And I said to myself, if I ever see an opportunity this good again, I want to be involved, but not as a regulator, or as an agent, which is what I did for 15 years or so at JP Morgan and Merrill Lynch, but as a principal. So fast forward, at JP Morgan, my bosses, I'd love to take credit for, but it was really my bosses, created a way for a bank to recapitalize without having to issue equity. They created the credit derivatives market, the portfolio credit derivatives market, the predecessor to the SRT market. And I was over in Europe, so I helped export that to over 50 or 60 non-US banks. Anyway, fast forward, in 2007, we came up with an updated version of that recapitalization. And we realized, it was 2007, anybody who was involved in the structured credit markets knew that winter was coming. And we had a recapitalization solution for the banking crisis that the banking system didn't yet realize it had on its hands. There was one problem. I was at a bank. So is then when I started returning the calls from Abu Dhabi and Singapore, leave banking, team up with us, and that's exactly what we did. So what we do is we provide solutions to banks, and for our investors, it allows us to get more return on the credit risk, corporate credit risk and asset-based credit risk that we take. We get more return than is justified by the actual credit risk we're taking. So by providing a solution that comes out of our regulatory background, we, for our investors, try to anyways get those superior risk-adjusted returns.
Yeah, and that's the fascinating far end of the spectrum, and then you kind of have everything else in the middle, which we'll get to in a moment. But you talk about that's just the evolution, what's driving the marketplace today. I mean, we were talking about this a little bit separately beforehand, kind of misalignment of illiquid and open-end kind of redeeming portfolios on the structure. I don't know if you have any thoughts around the fund vehicle itself, because that is quite topical these days.
Happy to answer. There are one or two things out in the news right now that are potentially putting a dark cloud over credit, private credit. But my comment is this. Most of our investors, and I would say still the majority, the vast majority of investors in private credit asset-based finance are institutional. Firms like Tina's, big teams who are sophisticated. There's city and state pension funds, corporate pension plans, sovereign wealths, and that makes up most of our investment base. Now, there is a desire to democratize that into retail and high net worth, and I understand that. I have a 401k as well, and I would love to get what the Tinas of the world are getting, and I get that. But this stuff it's a great asset class. It doesn't have the liquidity of publicly traded stocks or bonds. And I think where managers, including some of the ones in the news right now, got themselves into a little bit of trouble is if you're going to invest in private credit, have a vehicle that has a similar liquidity to the underlying. If not, you're relying on where the bid is. And right now, apparently, there's not a very good bid. And I think that the self-discipline that we need to do as credit managers is to make sure that we match our assets and liabilities. And I was a regulator, and usually I'm asking for less regulation, but I actually said this. I was on a panel yesterday. The one area where I think I would ask the SEC and FINRA for more regulation is to make sure that those retail and high net worth investors really are getting the same stuff as the larger allocators.
That all makes sense. Kind of thinking about that, both Satish and Missy, you've talked a little about the kind of the underlying deal leverage itself, because all this flows through. Like, how are the deals properly structured? How are you actually making sure they account appropriately and function the way they pitch to the investor base? I don't know what you think about that.
Yeah, so I'll just touch on a few points and build from what Paul said. Firstly, some of the sessions that were here earlier today spoke about like asset-based finance being this very broad asset class. I think one of the underpinnings is this is in most cases coming out of the banking system because of regulation, so it is bank-like credit. Secondly, there's a lot of debate about how large is this asset class, 20 trillion, 40 trillion, 5 trillion. And one of the objective measures that I look at that just started getting reported in the quarterly bank statements from last year is how much banks are lending to non-bank financial institutions. That growth in 2025 was 50%. It was about 20% for the 4 or 5 years before. And where it attaches to the liquidity and the asset liability management is every crisis has come from asset liability mismatch, whether we see most recently with the Silicon Valley Bank situation, First Republic, if we go back to the great financial crisis when there was too much leverage on, out on repo to Fannie Mae and Freddie Mac. Right now, I think the headlines are dominated around what I see as obviously a communication issue, and secondly is other liquidity terms that investors, especially the retail, pair up with the nature of the collateral. I think for asset-based finance, what it means for allocators, for investors, is really to go ahead. You might get your asset selection right, but what really drives the returns is really how is the funding from these banks. Because at the end of the day, you're looking at assets that are investment grade that are 200 over SOFR. give or take a few. You're competing with direct lending, which is 400, give or take a few, and you're relying on leverage. And so pairing that asset and the liability side, the success of the returns is going to come from the liability side of the equation, the structure of that liability, and how it works with the assets.
Yeah, no, I completely agree. I mean, just a couple things. I mean, we have evergreen fund structures that our firm manage, mostly institutional capital. Those are set up in a way where, to both Paul and Satish's points, you aren't going to find yourself in that liquidity mismatch given some of the redemption profiles of how that's set up. And so it becomes really important then, however, when you're thinking about the life of these, both the financing side of it that's coming from the banks, which is better regulatory treatment than if the banks were originating directly. To Satish's point, this is why you've seen this big kind of ballooning of lending happening in ABF. A lot of lending that was happening directly by banks is now happening by private capital. Banks are now lenders to those private capital firms. They can do that, particularly the US banks, at a much more attractive, in a much more attractive capital treatment manner than they could if they were doing those businesses directly. And so all of that kind of has to line up. The capital you're investing, the bank capital that's financing you with the underlying duration of the assets. And I think we're kind of seeing a little bit of a culmination of that happening in the market right now.
Totally agree. Tina, thinking about that, right, you are an allocator, so you're allocating across the alternative space and credit. What are kind of the risks you see?
I think the risk when it comes to ABF, obviously, has to do with the structure and how much stress the structure can withstand. I think everything comes down to collateral and then the structural protection. We've all been through. By the way, we don't have a large team. We have a large asset, but not a large team. We have a pretty. Our team, maybe it's pretty advanced in age, but
you have many consultants.
Well, consultants, they're not really in the asset level, right? So our team, we've all been through financial crisis. We all see how the subprime played out, right? Yeah. Subprime will happen, of course, when the asset quality is very, very poor. No matter how much there's no true diversification, right, in the underlying collateral. And of course, another factor that brought down everything was the asset-liability mismatch, right? There's a very short-term commercial paper market, and then banks own the originator. Now, if you fast forward today, obviously, bank no longer owns originators. Some large GPs, they own originators. Or insurance company, they may own originators, right? And then on the liability side, still the predominant provider of the capital is institutional. So the money is fairly long dated. Yep. However, if you see more retail investors coming to the space, and if the fund evergreen vehicle is structured in a way that it has, provides monthly liquidity, which may not be the best match for the underlying asset class. So when we look at the risk in the asset class, it's still very much classic asset quality, structure, and correlation.
So you talk about transparency from it. So how do you view kind of broad ABF versus, say, a direct lending business, or to you is it kind of the same?
I think ABF and they're both considered a core part of the allocation. Right, direct lending, obviously, we got into direct lending quite early, 2014, more than 10 years. So we have seasoned portfolios. We knew we are already seeing issues. We've been seeing issues in software, I think, as I mentioned yesterday, since 2021, when software company would purchase at 20+ multiples. After rate rise, software was already the weakest sector in terms of ICR. And asset-backed, we predominantly would prefer to be in more of a senior or mass type of. So if you think of senior part of the asset-backed structure, right, you can think of almost like a direct lending unlevered, and we can tolerate a turn of leverage. Mm-hmm. So that's the parallel I would draw with direct lending. And then with that core in place, that allows us the degree of freedom to invest in more niche-ier asset classes, take a little bit more of a subordination risk or some more credit risk. hopefully, and get paid, right?
Hopefully.
Yeah.
And thinking of that then, I mean, I guess, what is the value prop of ABF? I mean, Steve, I don't know.
So yeah, I see it slightly differently. The way I frame what all falls into ABF is, anybody who's been, and I've been at 3 different investment banks in the public securities part of the securitization market. Like, I see a lot of offerings out there. They're all targeting like low double-digit returns, and they are in the public sphere. They're looking at consumer assets that are securitized all the way to commercial, to residential, to ABS or MBS assets. And there are some offerings that are just trying to go ahead and get the best risk-adjusted returns up and down the capital stack. And then there is the owner-operator model, and I know you have it in your Q&A, where later that everybody has a view on, is what I think is a distinct subsector where you have the asset-based lending. You actually own the entire origination, the servicing capacities. So I'll give you a sense, like we talk about our teams, what I mentioned in my intro, we have 7,000 people in our complex. Most of them are controlling cash, are working on making sure that all the T accounts are lined up and the cash flow is secured from making the payments from these borrowers all the way to the end account holders, whether it's our public stock and what we're paying on our dividend or whether it's on our private funds. So I could not emphasize how important having direct origination and all the data you get around that to having control over those lending relationships through the life cycle of the asset and pairing it with the right funding is essential to the delivery of returns. I'm sure there's going to be a lot of dispersion around that 11 to 13%. I think they are just based on, obviously, a good Excel model and leverage assumptions and financing assumptions, but there'll be a lot of divergence.
Thinking about performance expectations, I mean, Värde is an interesting shop, right? You're kind of across the spectrum, but like, when you think about it, asset-based finance, what is kind of the returns? How should we be thinking about this?
Yeah, I mean, for us, so how we're set up in asset-based finance now is basically 3 main verticals: and we set up around asset class expertise. It's really important. I think one of the things when we think about comparing to direct lending is, it can be very broad, and they're very nuanced asset classes. So there's really a deep understanding you need to have around, the various KPIs for all the asset classes, et cetera. So we're very much organized. Folks on our origination side have been doing this for decades. They have super deep relationships. They understand the asset classes. They know the players. And so, we go to market with that asset class expertise and then provide solutions to and choose where we want to play in the cap stack. Do we want to be a lender? Are we comfortable buying the loans? Do we want to lend to the platform directly? And we do that within consumer finance, so that's all your traditional consumer finance asset classes you would think of, right? Personal unsecured, auto loans, home mortgages, that sort of thing, credit cards, student loans. We have a commercial finance division, which is equipment leases. We do a lot in the SME lending space, small balance SME, things like supply chain finance, et cetera. And then we have a fund finance vertical as well, which I think is a very new and up-and-coming really area of itself within ABF. Notably, like, for instance, we love real estate. We do that out of our real estate group. Some people put real estate in ABF. So I think this notion of what are we really talking about when we talk about ABF is like a pretty important question to distill right up front. But then within, to your returns point in particular, we can take a view on each of those individual asset classes. So many of them have so much granular data that's coming in. So we have a lot of data that's telling us, where are we comfortable playing in the capital stack? Again, do we want to be a lender? Are we comfortable buying the loans? And then with that, you can calibrate your expectations of return based on where you are in the capital stack. You can utilize financing from the bank to get your returns to where you need to be. So, all in all, I think you're going to get paid more in the private markets than you would by just buying CUSIPs outright. I mean, it's why we play in the private markets. But I think, having the underlying expertise and the flexibility to kind of, choose where you want to invest becomes pretty important.
Agreed. So, I mean, thinking of some of the things you touched on, I would call as heavy assets versus light assets. And Paul, in the SRT space, right? Could you walk us through that a minute and talk about what you're actually seeing today? Because that is very unique, right? You have a very European business model and you have a US ecosystem, and they're not the same.
Well, yeah, I think it's right to make that distinction between Europe and the US. There are times when Europe and the US, in many ways, go in tandem. Whether it's politically, geopolitically, or I would say opportunity-wise, I have not seen Europe and the US be a more divergent path than right now. I'm involved in the Munich Security Conference, and I was just there for 4 or 5 days a week and a half ago. And I really feel in political, geopolitical land, we're apart, but actually in the opportunity set, we're apart. I'll talk about SRT, but it's really true across most of our lending businesses, and there's good reasons. So in our asset-based, hard asset lending business, much better opportunities in Europe. In SMEs, much better opportunities. When I say much better, we're talking like 200 to 300 basis points of more return per given risk unit than here in the US. If I had more time, we could talk about the structural reasons why. But you asked about SRT, same story there. We at Orchard have done, since we founded the company 16, 17 years ago, we've done about 200 billion of these SRT transactions, 95 transactions, 21 banks, some US, mainly Europe. And here's how I like to think about this. If you look at an investment grade portfolio, well-diversified investment grade portfolio, we'll team up with the bank and we will usually take the first 10%, first 8% loss. So kind of structurally leveraged position. And what the models tell you is, fair value on that is about cost of funds, SOFR plus, 4 or 5%. Well, there's been in the last year or so a lot of US banks doing deals, and guess what? They're priced at 4 or 5%. So I can't say they're expensive, but they're not really cheap either. They don't offer the type of value that, when we go to the Tinas of the world, we say that we're better, that's kind of fair value. Europe is very different, much more opportunity. We have been doing deals, as apples to apples as you can get, full investment grade deals, same kind of first 10%. And we did one deal in the last 12 months at cost of funds plus 9.5. I think that was an outlier. But we're consistently getting that cost of funds plus 7, 8, 9, 9.5. And that's what we talk about when we talk about better value in Europe. Why is it? The banks don't have the capital in Europe. The market doesn't have the capital in Europe like it does in the US. There isn't a BDC market. There is in Europe. There is a much less well-developed securitization market. The CLO market is less well-developed. And if anything, banks are deglobalizing in Europe. So it's kind of simple supply and demand. The European banks need the capital. They're willing to subsidize the trade more. And that's where the, if you will, alpha comes from. We at 7, 8, 9%, we are getting overpaid for like I said earlier, the corporate credit risk that we're taking. So that's maybe a way to think about Europe versus US in the SRT space.
Oh, perfect. Let's flip that a little bit. And obviously there's a panel earlier today on private credit which touched on some of this. So let's stay away from the news. But Missy, what is mid-market today to you? what is the good, the bad, the ugly? What do you guys actually see?
Yeah, so the way we define mid-market and ABF is more I think about it by deal size. So to think about equity checks somewhere between 50, 150 million. I think once you start getting above the $150 million deal size, you start attracting the much deeper, larger pockets of capital and being much more of a price taker in deals. And so if I go back to what I was saying before about how we approach the market as more of a solutions provider, a lot of this is deep relationships where you can, grow with platforms and understand what capital solutions they really are trying, or capital needs they really are trying to solve for. And what we find is that can be really sticky business. So maybe that's a origination platform that hasn't accessed the securitization markets yet, or it has, but it's entering into a new geography or a new product. And the more we can kind of take that relationship approach, it becomes really sticky business and you grow with them. And then even once they are doing those larger deal sizes, it becomes once you're a trusted partner, certainty of execution becomes super important. So I think it's why we like that middle market space. You get paid more outsized returns than you can playing larger, and I think our expertise and relationships suit it a bit better.
So the few minutes we have left, something that I want to get back to, you've all mentioned is, kind of your underlying expertise, the platforms, the people, the resources. Satish, I don't know if you could give us a second and just talk about kind of what goes into it. How do you stand out? Like, it is a crowded market. Today there are lots of folks who say we're private credit, but what do you do to actually get out there and outperform?
So I think it's all in our history, having it organically built, new res, used to be new residential, as a mortgage company, servicing a book of 4 million consumers, working with hundreds of home builders throughout the country. Having the, I think at the very outset I think you're going to get the results based on how you underwrite the collateral. And what you see is what you're going to get. And so I think it's just having those control levers at the very beginning. Now, I do see that there is a push right now for a lot of platforms that don't have that captive origination to create partnerships. And to be able to source this collateral, bring it into their fund strategies. I don't think that I would make the leap of faith and equate that to having your own captive origination, because it's all about context and contextualizing what you can get out of a relationship, of a partnership, versus having deep data, having the relationships, having the credit controls over the borrowers that you are working with is essential. And I don't think you can replicate that in a partnership type structure as fully. And so I see a dividing line out there in the market. And then I think just being able to go ahead and literally, there are going to be hiccups around the way. I think to some of the headlines today, I saw a post before coming into this panel that it's really going to rely on the workout capabilities of the managers. And so you need to really equip yourself with that deep of a bench in making sure that you have not only what's written down in the covenants and the structures of the loans up front, but these hiccups are going to happen, these cycles are going to happen. You've got to go ahead and work your way through. So I think that's where a lot of the, I'll just close with this because you said we have a few minutes. Downside protection and real assets is the calling card, but the question that we raise is, how much downside protection does the manager bring, and how real are your real assets? That's where I'll leave it off at.
Great. And Tina, any thoughts on data for a second? Because all anyone talks about is, what is the underlying data? Do you see anything that kind of different strategies people are employing?
Well, data is the most natural in granular portfolios. For example, residential mortgages. It's a long history of lending, down to each asset MSA, right? Amazing system have been built, including where you were before. A lot of expertise in that, right? And that translates, of course, to non-QM, second lien, HELOCs, all kinds of resi-related securitizations. Outside of that, right, certain asset classes are fairly new, consumer unsecured. But I think nowadays there's enough history about consumer unsecured, right? What data comes into play is really how you use it, how you stress it, and the assumption you're using. So it's garbage in, garbage out. If you can manipulate that to spit out a price or loss rate.
Mm-hmm. Great. I think with that, we're at time. Thank you.
Thank you.
Thank you.